Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I will be your host here for about the next 25 minutes. Well, the markets are definitely not doing what I was thinking was going to happen. I just thought they would do something. The only thing that's actually kind of interesting in the marketplace is that, the VIX is just hanging out right around that 20 level. But we have the VIX hanging out right around 20. We got the SPX up about 0.4%, up 26 points on the day. And I don't know exactly what I thought would happen, but it wasn't this. I just expected a lot more volatility in the marketplace. We're just taking things in stride with the geopolitical concerns from across the bay. And then we have USO, the oil trade that we looked at on Friday. I thought it would be a boost. And at this point in time, we're down 1% on the USO trade. It's nothing to be concerned about at this moment. The trade is still looking fairly good. So got a lot of vol premium when we sold it. And I think the vol premium is still kind of hanging around. But surprised to see oil down a little bit and USO down with it, which is the ETF that actually tracks the oil futures, the short-term oil futures contracts. And so I want to do a couple of things. I don't know if I'm bullish on the SPX, but we haven't done a skip strike butterfly in the SPX in quite some time. And I do not foresee us, I don't know, over the next 4 days or so, blowing the markets away, considering all of the concerns. We got the VIX at 20, which helps with the butterflies. So when the VIX is around, when the volatility is elevated, butterflies are cheap. So the ideal situation when you're doing a butterfly is that you have vols elevated when you put them on. And then as expiration approaches, your ideal thing would be that vols would come down. So it goes hand in hand with bullish trades in the SPX or whatever underlying that you're trading in. So I have more apt to do a skip strike butterfly on the call side of things above the market than below the market because of this rationale. Now, the biggest thing about doing a skip strike butterfly in the S&P 500 index is that you need time decay. You need a lot of time decay. It is a Monday, so if the market goes against us, it's going to hurt. We need at least 3 days worth of time decay in order for our skip strike, our butterfly that's embedded in our call spread, right, to help pay us out. And I always do this is an alternative to doing a short call spread. And I think a short call spread is a viable trade at this point in time. And I'll work through it one more time with the math. But I don't mind selling a short call spread when we see the VIX elevated like this. It's down a little bit today, 35 cents on the day, and the market's up a tad. But we're hanging on to that 20 level. And the market is just kind of like, oh, well, I guess, nothing really happened over the weekend, which I don't really get that. But with that said, that's the way the market is reacting. So in the SPX, we're going to go out a little less than a 1 standard deviation move. We're going to look at around a 20 delta because we're going to bring in some real premium here. And I'll set up the skip strike butterfly, but then we'll come back and we'll look at this is the alternative to the short spread. And I'll parse it together for you. Okay, so let's go to the Tradier Pro software. And by the way, please do feel free to participate in my reindeer games. If you have any questions, please do put them in the chat box, and I will try to address them during the show. I feel like the timing is right. We're right below that 6,000 level. I don't think we're going to get to a point where we're going to set an all-time high. I'm going to try to bring in some decent premium on this trade. We're going to have about $1,000 worth of risk. It's an interesting trade for the week. Okay, so here we go. Right now we have the S&P 500 index trading right at 6,000, right? Very close, $5,998. We're going to go out to the 23 delta. I guess that's moved a little bit. So this might have went up. Yeah, 140, 150. All right, we're going to right on the 6100. See, I just don't really see the market getting to that. Let's go take a peek at the chart. Oh, chart. Let's go take a peek at the SPX chart, not the actual chart tab. Here we go. So right here, 6147 would be a new all-time high in the SPX. And yeah, 6100 is right in this range. This is this high way back here. Let's go a little. Let's adjust this up one, because we don't need a $1.50 credit. Anywhere between a dollar and $1.25 is actually okay. So let's adjust this, and we'll go 675, which is the 21 delta. And let's even get rid of that one. Let's do the 20 delta. So we're going to buy the 20 delta. We're going to sell 2 of these. We're going to skip the 110 and buy the 6110. Yeah, there we go. Dollar net credit to the account. So stay where you're at, market. Okay, just for the sake of the show, we're going to send this to the what if calculator. We're bringing in about 10%. That's always kind of my goal with skip strike butterflies. I'm going to have $1,000 worth of risk. I like to bring in at least 10% of that, which is about $1 in this instance. You got 10 points. That would be $1 if you want to do it in pricing terms. And so we're going to go up to the June 27th expiration, which is this Friday. We're doing the SPXW, so it closes at the end of the day. The options will trade all day long. So you have the rest of the day today, all day Tuesday, all day Wednesday, all day Thursday, and all day Friday to get there. We did we send this one to the what if? Let's send it. Bringing in $1, putting up 1,000. Now you can do this more than one if you'd like. I always just do it in terms of one contract. Here's where the market is at. 5,998. Vol is up. If the market goes this way, right, to start with, we're going to be down. Now, ultimately, over time, what will happen is this will start morphing into what it looks like at expiration. So every day that goes by, our risk, if the market goes against us, goes down, because this line will drift up a little higher, a little higher, a little higher, a little higher, until it's profitable if it lands within the strikes. Now, out of all of these butterflies I've done in the SPX, you really don't start getting that large rate of time decay that you need until the last day, and in particular, until the last 4 hours of trading. The SPX really holds its value. But one other thing that can help, though, is that if we do get to move to the upside, that usually means that the VIX will come down. And that also helps, because our issue is the risk that is created from selling 2 of these option contracts. You need those option contracts to get to zero, as far as time value is concerned, as quickly as possible. So implied volatility coming down will help that trade. All right, so this is going to be the official paper trade for this week. We're going to do a skip strike butterfly in the SPX, mainly because the VIX is elevated and the market is doing nothing. So with that said, right around the 6,100 level is where your risk kicks in, and we can actually go back to the what if calculator and show that. Right here is where we break that break even part, and that's mainly because now the short spread is the driver of the strategy, and it's from 6,100 to 6,110, 6,110, right here, this strike. All right, so if you want to check out the skip strike butterfly, I didn't bring it up, but you can go to optionsplaybook.com and type in skip into the search bar, and it will come up. It'll offer you a skip strike butterfly on calls and puts. Very easy to see my layout inside my book. Now, if you want to understand the guts of this trade, here's the alternative. So I'm going to get rid of these 2 things. Like I said, we're skipping the strike that would be the short spread. So we're doing this for $1 net credit. 6,100 is where the market is at. 59.80. Okay, let's get rid of these two legs and say, all right, what happens if we just sell the short spread? We bring in $1.40 to $1.45. We'll call it $1.40. That's what popped up. We'll leave it right there. $1.40. Okay, so what this means is that the standard butterfly, 10 points wide, should be trading for 40 cents. If the market behaves and doesn't go crazy on us, that should be trading for 40 cents, because this is what we did. We're selling the short spread and we're buying a butterfly as a hedge in case the market goes against us. So now let's remove the 6100 strike. And I don't mind this trade at all. You're looking right at a 1 standard deviation move. And what's one of my favorite things about the Tradier Pro software is this little feature where it highlights right around a 1 standard deviation move. You can always confirm that by looking at the delta. The market's moved a little bit, but the delta should be around between 14 and 16, somewhere in that range, right in that range. So we're at 6,100, about 1 standard deviation move and beyond, because we're at a 13 delta on this. We get rid of this trade, this leg of the trade, and that means we're going here. We're going to buy the 680. We're going to sell 2 of the 690s. This one needs to be a buy of the 680. Selling 2 of the 690s. And then we're going to buy the 610. That should be about 40 cents. 35, 40, 35, 40, 35, 40. Yep. So you sell the short spread. That involves selling the 6,100 strike here in the SPX. We then take the profits and buy a butterfly as a hedge in case the market goes against us. And that means that requires us buying the 6,100 strike. So why do that? Why sell the spread and then buy the butterfly as a hedge? Why don't we just put it all together as one trade and skip this strike, the 6,100, and buy this strike? Now it's trading for 115. Not bad. $1 was what we're looking at. I think $1 is a solid risk reward. Now, that also means that there is a margin requirement. If you were short the short spread, you would have a 10-point margin requirement for every short spread that you are short, every 1-by-1 spread, which means that's $1,000 to put that trade on, and you have to be approval to do. You have to have the approval to be short spreads in an index, the SPX. If we do that trade, that would get held out. So that's going to be the same case here, and that's our risk on this trade. But I like the setup of this trade, considering what's going on in the marketplace at this point in time. I think it's going to be really hard where the market's considering the geopolitical situation, and we still got tariff news. We still got a lot of other things that are just kind of laying in the weeds out there. It's going to be very hard to try to break through towards an all-time high in the SPX this week. All right, now I also decided a stock that I'm getting a little bit more bullish on is Amazon, and I'm like, well, let's keep this skip strike thing rolling. All right, let's go out. Let's do 1,200 days. And then more defined on the 200-day moving average all the way through here. That acted as an area of support. And then we've had a couple of good things happen here, right? We had the 20-day crossover above the 50-day and then crossover above the 200-day, and the 50-day moving average is starting to move up. If I look at the chart here, right at this level, this is obviously an area of resistance. And let's scroll out a little bit here. And you see there's a lot of activity, right? Right here, this has acted as support on the downside. and we bumped up, then it acted as resistance, and now it's back acting as resistance again. So wouldn't mind doing a short spread in here. I think that it's going to struggle to try to break through this level, but we do got some positive momentum. So once again, I'd like to go out and look at a skip strike butterfly, but we're going to have to go out a little bit further in time. And that's mainly because Amazon is a lower price stock than the S&P 500 index. So there is a less premium just because of that, not because of volatility, but in general, because a lower price stock, option contracts are priced accordingly. Just like if you think of car insurance, if you buy car insurance on a Bentley, it's going to cost you more than on a Chevy Cavalier, right? The more expensive the underlying, the more expensive the option contracts will be, or the insurance contracts, which is where the options marketplace came from. All right, so let's go back and look at the what if calculator. I set one up before the beginning of the show, and let's see if this one still applies or if the market's moved too much against us. All right, so exact same profit and loss graph we saw in the S&P 500 index. We're going to go out to the July 18th date. So this is going to last over the holiday, over the 4th of July. And we're going to go quite a ways out, though. We're going to look at doing the 220 strike. We're going to stick right around that 20 delta. We're going to send this to ticket. Let's look at the trading page. And what if we are the July 18th? July 18th. Expiration. Man. Oh, I'm in the SPX. That's why. AMZN. There we go. Yeah, now we got to go back a little bit. 25 days away. All right. This delta's 25 at this point. So that's moved on me a little bit. Net credit of 17 cents. So we got $2. So $2.50 is our short spread. I'd like to go 5, but I couldn't get it done for a net credit. 10 cents would be 25 cents on that trade. I would like to get 25 cents on the trade. But right now it's trading at around 20. I don't know if I move up to this one, if we want to do that, then we're at a 30 delta. I think that's too close. Yeah, I go back to 20. There we go. Let's get 20 cents for it. This is where my trade is at. I put it in right now. I want to get 20 cents on it. We got 2.5 points wide. I would end up doing more than a one lot on this trade, as opposed to the SPX, where a one lot is more than feasible. But you could do 5 of these and have that same type of risk that you would have in the S&P 500 index, because you're 2.5 points wide. And if you did 1 by or a 5 by 10 by 5 skip strike butterfly, you would have the same amount of risk approximately, and you'd be bringing in close to the dollar on that trade. Yeah, you would, right at 20 cents. So I'm solid with this trade. If we can get this done for 20 cents, I like it. And this is going to be a little bit longer term. I will take a screenshot, we'll watch it, and we'll hold that position. All right. I do not see any questions. If you have any questions, please do put them in the chat box. Now, lastly, I'm just going to review our USO trade. We just put it on Friday. So let's go to the USO. Oh, I didn't put it in there yet. Okay. And we quite simply just sold a short spread right around that 80 level. Stock is down 1% on the day. Well, I should say the ETF is down 1% on the day. And we are just down a few pennies on the trade right now. It's not that big of a difference. Sold it for a net credit right around 150 to the account. We sold the July 2nd expiration, and that's 9 days away. And we sold the 80, and we bought the 76. Yeah, so we're actually making some money on the trade right now. I don't know. I don't know if vol's coming off. I don't know exactly. The stock was at 82.59, so we're down. Yeah, that's got to be all volatility. All volatility. So you could actually buy this and make 20 to 30 cents, depending on where you filled it at. I see on my screenshot, the midpoint was 150, but I have in the limit price $1.44, implying that that's probably where we might have executed it if we would have did it at the second that we talked about the trade. So vol is coming in. Time decay, I guess, big over the weekend. We only got 9 days left. Solid setup. And that was if you think about it and you go back and you look at the USO trade that we put together on Friday, I talked a lot about the reward risk ratio, which is always quoted backwards as the risk reward ratio. I hate that about it, but very solid risk reward. And it had a lot to do with the skewing of volatility to the upside. And the puts were cheap relative, and they're still not bad, right? So you're paying 54 for this 54 and IV is 54 on the out of the money put, and on the more at the money put, it is trading for 56 vol. So positive skew. That's usually the reverse on that trade. And then on the other side of the coin, when you start looking at vol on the out of the money call options here on the same expiration, you see vols are going up. So most underlyings, the situation is the exact opposite. So to me, this is implying more people are buying call options than they are buying puts, especially on the out of the money option contracts, making the smile positive towards the upside. It is a bullish sign to me to look at implied vols and see this scenario. Doesn't just one little piece in the puzzle doesn't mean that it's going up. But it also provides us a nice risk reward ratio because we're selling higher volatility than we're buying. So we learned something today. And that was part of the reason why I wanted to do the trade on Friday, is because of this little scenario. So on top of it, we're a little bit bullish, but I like the fact that just the setup was nice. And it doesn't happen that often in individual stocks or even individual or even indexes, right? But it was happening in the USO heading into the weekend. And it's still there. That skew is still there. All right. So that's it. We got one comment before I take off. I'm about ready to sign off here. If the USO trade is done today, would you need to make an adjustment to the trade from Friday? If the USO trade is done today. No, if we put it on today, would you make an adjustment? All right. In other words, no, I like it here. You're just going to lose. You don't quite make as much money. I guess we could go below the 80 level. You want to look at the price of oil more than anything though, but 80 is right here on the chart. Go down to 78. It doesn't really help us on the chart, but I think I would leave it right here. I would leave it right at the 82 and just accept the fact that I'm going to get $1.26 as opposed to $1.45 or $1.50. But you also went through the weekend, and the weekend is huge because of the news events. And I said that on Friday. I said, there was obviously volatility heading into the weekend because of the risk of the potential news over the weekend. And then we obviously got huge news over the weekend. And like I said at the very top of the show, and I'll reiterate one last time before we sign off here, just really surprised to see where the markets are at. The markets are doing nothing. The VIX is still staying elevated, but it's not dropping precipitously because the markets are up. So that unrest is still there, but the markets aren't going anywhere. So yeah, I would keep it right here. This is where I would keep it. All right, everyone. Well, that's it for this edition of Options Guide TV. I appreciate the question. We'll be back on Wednesday for the next edition of the show, 11 a.m. Eastern time. I like the SPX trade this week. I like that one. I'm going to put that one on in my own account, and we'll watch that one closely. The Amazon trade we'll keep an eye on it. I'm not going to put that one on in particular, but I do like the trade. There's nothing wrong with it. I just thought I'd let you know that. All right. Thanks for tuning in, and we'll see you this Wednesday at 11 a.m. Eastern Time inside the Tradier Hub for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.